Okay, just confirm, is my screen showing from your side for all of you? Just confirm. Can you now see my screen from your side? Those joining online, just confirm. Can you now see my screen?
Yes, sir.
Okay, that's brilliant. So, welcome to our fourth revision session. So, in today's session, I want us to shift from the online platform that we're looking at. So in today's session, we are looking at the September 2024 to August 2025 question paper. So I think on the online platform, there was that last question we had not finished up. So please, you can just attempt that one. The answers will be available as well on the platform. So you can just attempt, then um, if you find any challenges, then you can get back to me, then I'll assist you. So today, let's introduce something new. We are going to look at the September 2024 to August 2025. So I'm sure regarding the structure and whatnot, you are now familiar with all that. So let's not waste time on that. So let's look at the first question. Which two of the following, which two of the following are direct expenses? So remember, the whole point is not about just knowing the answer. The purpose of the revision session is not just picking the answers, but it's about understanding the principles surrounding the selected answer. So if you are to get another question, you're supposed to be able to come up with, if you're going to get another question, maybe with just different ideas, you're supposed to be able to come up with the answer. So it's not just you picking the correct answer, but understanding why we have chosen that answer. So which of the following are direct expenses? Which of the following are direct expenses? So, which of the following are classified as direct expenses? Number one, a cost of special designs, drawings, or layouts for a specific job. The hire of tools or equipment for a particular job, salesmen's wages, rent, wages, and insurance of a factory. So which ones can we classify as direct costs? So remember, our costs that we incur in the business. We can classify this. So let me just indicate that's day 4. So I will send you these notes. Please just remind me so that I can send you the day 1 to day 5 notes. So this is day 4 of the revision session. Okay, so we have said the costs, the total cost for a business. The total costs can be direct costs, or they can be indirect costs, which we can give the name overheads. So we can have the direct costs and we can have the indirect costs. So the indirect costs, they can be termed overheads. What are the direct costs of the business? So the direct costs, we are looking at the costs that increase with the level of output. So the more you produce, the more you tend to incur these costs. So the direct costs, these costs increase with the level of output. These costs increase with the level of output. These are the direct costs. They increase with the level of output. Then the indirect costs. If the costs are indirect costs, so for the indirect costs, these ones they do not increase with the level of output. Or in other words, we can say the indirect costs, these ones, they are fixed in nature. So let's think of rent as part of indirect costs. You pay rent whether you use whether you have, maybe in our case, whether we have one student or we have 100 students. The rental is not dependent on the number of students. So that can be classified as being an indirect cost or an overhead. So the indirect costs or overheads, these ones, they are not dependent on the level of output. These are not dependent on the level of output. Okay, with that in mind, now let's go to the question. Let's go to the question and you tell me what you think is the correct answer. Okay, so which two of the following are direct expenses? So let's now work together. Which can we classify as being direct? Those that increase with the level of output.
A and B.
A and B. The cost of special designs, drawings, okay, salesmen's wages, those are part of salesmen's wages. Those ones are not, these are factory overheads, so they are not part of the direct costs. Rent, wages, and insurance for the factory, again, those are not part of the direct costs. So if the costs are specific to a job, then they are direct costs, because if we don't produce that product, or if we don't go ahead with that task, the costs are not going to be incurred. So by them being specific, then they are direct to that job. So it means if we avoid the task, we avoid the cost. But unlike the overheads, they are likely to be incurred. So the hire of special equipment, since again this one is for a particular job, it can imply that this one is a direct cost. It's associated with that task. Once we avoid the task, we can avoid the cost. Now, let's move on. Storm Private Limited Company has just developed a new product to be called the Rain and is now considering putting it into production. Which of the following costs or revenues would be relevant to a net present value calculation? Tick the box. Remember, in the last session, I did discuss with you the relevant costs. And I'm not going to start the discussion all over again, but maybe if you're lucky, we can just go and figure out what we said. Yes. So this is relevant cost. I said that a relevant cost, it's supposed to be a future incremental cash flow cost, which will result in us paying money. It must be, number one, a future cost, it must be incremental, and it must result in cash outflow. If a cost has already been incurred in the past, that is a sunk cost. And for decision-making purposes, sunk costs are not relevant. Then a relevant cost must affect our cost structure. If it's not going to result in an increase in the cost, then it's not relevant. Then it must result in money going out of the business. So now with that in mind, let's go and look at the costs that we are given and try to classify them as being either relevant or not relevant. The question, however, is saying, can you tick those that are relevant? Can you tick the relevant ones? Costs incurred in development of Rain amounting to 480,000. The Rain is the product we are producing. So the costs incurred in the development of Rain amounting to 480. Is this relevant or is this not relevant?
That one, it's a sunk.
So Bowen is saying it's a sunk cost. Do you mind telling us more why you have said it's a sunk? Okay, let's proceed. Are you still saying something, Bowen, or we can proceed?
Yeah, it is already incurred. Cost
Yes.
incurred in the
Yes, that's correct. The term incurred implies that it's a cost we have already spent, it won't be affected. Whether we go ahead with the decision or not, it's already incurred. It's a sunk cost. Thank you for noting that. What about the second one? Purchases of new machinery at a cost of 2.4 million, payable immediately. Purchases of machinery. Yes, Bowen, you can go ahead.
That one is relevant.
That one is relevant because this one is payable. It's not paid, but it's payable. It means we have not yet paid it. So that one is a future cost. Then depreciation charge. Depreciation, is it relevant or not relevant? Depreciation charge for the new machinery of 600,000 per annum. I want someone else who is not Bowen, please. Others, can you please come through as well? What do we say about the depreciation charge? Let's work as a team. Even Noku, you're allowed to help us, please. Depreciation relevant or non-relevant? It shows that a lot of you are not even listening. So remember, what did we say a relevant cost is? A relevant cost is a future cost, it's a cash flow cost. Is depreciation a cash flow cost? No, it's not. In the last question, it was there as well. Depreciation is not a relevant cost. It's not a relevant cost. Reason why? Because it's a non-cash flow cost. A relevant cost should result in us paying money. Management accounting is not difficult. They just give it that that buzz, but it's not a difficult subject. So remove it from your mindset that this is difficult, because this is just a matter of you understanding the principles behind. Then the rest is easy. So depreciation is not a relevant cost. Reason being, it's a non-cash flow cost. Then sell price of $80 per rein. The selling price of $80 per rein. So this one is a future, because the selling price is not something that we have incurred in the past. It's what we are going to be selling at. So that one we can consider it for, because if you're calculating net present value, you want the costs against the revenues. So you say the costs you expect, the revenues you're expecting minus the cost. Then you get your expected profit. Then you can use it to work out your net present value. So that one, the last one, the sales are taken into account in decision making. They are relevant. What is the weighted price index? Using 20x1 as the base year based on the following data. So what is the weighted price index? So remember the indexes. So if we are looking at the weighted price index, let's go to our Excel and just say something about weighted price index. So for the weighted price index, what is it that we'll be looking at? So we can say for the weighted price index, we are looking at the change in the price for different items. So the impact, so this looks at the impact of the change in price This looks at the impact of the change in price for various change in price for various items. Change in price for various items. So if the prices are to change, they impact on the quantities that have been bought. So if we change the prices, it's going to have an impact on the quantities bought. So we want to look at the impact of the price changes for various products, not just one. If we change prices of different items, what is going to be the impact on the, we can call it the basket or the portfolio basket. So if you were buying these quantities, if the prices are to change, how is it going to affect your purchasing behavior? So we have what we call the base year. The base year is the one that we are using for comparison. So if you're saying there is a change in price, we are looking at a change as compared to another year. So the year which is used for comparison, the year used for comparison is the base year. If you are talking about the base year, is the year we are comparing against. The prices have risen against what? So the base year is the year we are using for comparison. So if it is the simple price index, the simple price index compares the current price of a commodity with the base year. So for a simple price index is looking at the price against the price of the base year of a single product. So why do we need to know about the simple price index? Because if you're calculating the weighted price index, we are now looking at the impact of the change in price on different products. But partway, when you're calculating the weighted price index, you need to first of all calculate the simple price index. If we are looking at 2001 and the year 2002, if we are looking at 2001 and 2002, if in 2001 the price was $20, and now in 2002, the price is now $30. So the price index, the simple price index would say the price index, to work out our price index, would say so to work out the price index, would say the price for the base year over the current price. So if we say the price for the base year, or we can say, so it's supposed to be base year of, if we say, so we are saying 20 over 30, what we get? Let me just, can you work this one out for me? What's the 20 over 30 times 100? So as a percentage, what is that change? So that would be 66.6. So that would be 66.6. Let's move on. So in this question, the question is saying calculate the weighted price index. calculate the weighted price index. So the first step here, let's go to the question and understand the question more first. So can you read the question and maybe analyze it? Then we work through it together. So we are given the price and the quantities. So in this case, 20x1 is our base year. 20x1 is our base year. Just thinking, I did the reverse here. It's supposed to be, the simple price index is supposed to be the current price of a base. It's the current price, which is, if we're in 2002, it will be 30 over 20. It's the current year price over base year price. So we're saying simple price index is equals to the current year over base year. So it's the current year of base year price. Okay, let's go to the question. Read through the question. Okay, let's go ahead and work it out together. Let's go to our Excel and work it out together. So if you're dealing with a table like this, and the question is saying, calculate the weighted price index. The first thing is to note which one is our current year and which one is our base year. So our current year, the weighted price index using 20x1 as the base year. So if 20x1 is the base year, it means the current year is 20x2. We are now in 20x2, we're looking at the changes in price from 20x1. Then what is then the first step? The first step, you need the price index for each product. You need to work out the price index for each product. So let's go and work out the price index. Then we multiply the price index times the quantity, and you divide by the total quantity. So let's maybe put the steps down. So step 1, you need to get the price index for each product. Step 2, multiply the price index with the quantity. Then step 3, divide the price. So you divide the product of the price index or you can say divide the product of step 2 with quantity. with total quantity. We're going to do the steps together. So the first step, we need to get, we have two products on our question. We have two products. I think it's, we can take a pic, please, so that you can help me out with the amounts. Just take a pic of the question. Those who can. Okay, so we have towel and bucket. Then we have the quantities, the prices. Okay, so let's go to our Excel. So step one, we need for towel. So we have towel and bucket. So for towel, let's start with our price index. So for price index, remember we are saying the current year price. For towel, what is the current year price? Over the base year price?
That's 2 over 250.
Then times 100. Then we do the same for bucket. For bucket is what's the current price? 3 over the base year price. $50 we multiply by 100. So it's the current year over the base year times 100. After doing that, the next step, we can do it in front here. So the next step is we multiply the price index with the quantity. So let's have the quantity. Let's have the quantity. Let's have the quantity. So for the quantities, we have 250. And what? What was the other? 300.
300.
Then let's get the product. So the product of price index and the quantity. $20,000. Then we are done with step 2. Step 3 is the final step. So for us to do the final step, you need the total for the quantity and you need the total for the product. So the total for the product is 80,000 and the total for the quantity is 550. Then, so the final answer, the weighted one that we are looking for is the weighted price. So the weighted price index, we then say the total, that's step 3, divide the product of step 2, which is 80,000 divided by 550. So what you get is your weighted index. So what do we get if we say 80,000 divided by 550? I think this one, there were answers. Let's go and check if we can get that answer. 145 point. So that's B. So if you round off to 1 decimal place, that should be B. So take note of those steps. Okay, let's move on. Time is not on our side. A company wants to calculate the EOQ. Good part about these things, the more you do the questions, you end up seeing that they'll be talking about the same issues. So the company wants to calculate the EOQ. In the last session, also we did mention something about the EOQ. So for an item of inventory, the following data is available in the spreadsheet. What formula is required to calculate the economic order quantity? To calculate the economic order quantity, which formula should we use?
Square root of 2 quad over CH.
Square root of 2 quad over CH. Square root of 2 quad over CH. Do we have the square root of 2 quad over CH on our answers? So which one is now a substitute for that? From the answers, which one is talking about square root of 2 quad over CH?
C.
So C is saying 2 times B2 times, so what is B2? B2 is the CO, that's cost of ordering, yes, times B1 times 12, yes, because that one is monthly, of which we want the annual demand. Then over B3, which is the cost of holding inventory. So yes, C is the correct answer. So it's the square root of 2 quad over CH, where D is the annual demand. They normally play around the demand. So don't just take the units given, consider are they for the year, because the demand is for the year. And also the CH is the cost of holding 1 unit of inventory. If they give you for all the units, we want for 1 unit of inventory. So we want the cost of holding 1 unit of inventory. Now let's move on to the next question. So the next question is saying, Chiefton Cleaning Services supplies its employees with protective clothing. One such item is protective gloves. Records from the stores department for January showed the following. The records showed the following. What is the value? What is the value of the issue and the closing inventory if the FIFO method is used? What is the value of the issue and the closing inventory if the FIFO method is used? So it's just a matter of you calculating the value of inventory using the FIFO method. Remember, under the FIFO method, the assumption is what came in first is the first to be sold. So if we are to sell, we sell first the goods that we bought in first. So what is the value of closing stock and the value of issues? This one I will give you a few seconds to try. Should take you very few minutes to try. Okay, I'm now expecting the answer. Are you guys, is this one again, you can even work it out without using any, just by looking, by inspection. So what is the value of the closing inventory? Let's start with that one. So regarding the value of closing inventory, we are told that, so regarding the value of closing inventory, we are told that our opening inventory is 150. The purchases on 7 January is 40 pairs, of which FIFO says the goods that came in first are the first to be sold. So if we sold 30 pairs, it means we removed them from the batch which came in first. That is the batch we had as opening inventory. The 35 still, we removed them from the first batch. So all the units we sold, it means we removed them from the first batch. So it means we had 150. So from the opening inventory, we are saying we had 150, we deduct the 30, we remove the 35. It means from 150, how many are we going to remain with? 150, we remove the 30, we remove the 35. So from this batch, we are going to remain with 85 units. Then the batch which we purchased during this year, that one is not touched. So the purchases which we made during the year of, is it about 40 units? Those are not going to be touched. So these ones were made, those were purchased at $90. So that's 40 times $90. So we still have them all. Then these ones, we are now remaining with 85 times, each unit is going for $2. So overall, if we add up, how much is the value of inventory that we have? So we have 170 from the first batch, we have this from the second batch. So in terms of the value of what we sold 30, all the units were sold from the first batch. So we sold 30 and 35. That is, you sold 65 units at inventory was valued at $2. So the issues are valued at 130. Those that we sold, we were valuing them at 130. So now with that, let's check, do we have 130 and 246? So let's not waste time on that. Let's know. The following data is available for tellers in period 2. Actual overheads, the actual machine hours, the budgeted overheads, the budgeted overhead absorption rate. What were the budgeted machine hours? What were the budgeted machine hours? So we did a question which is similar to this one, but it was asking us about the over or under absorption. So if we reverse that one, it can help us calculate the budgeted machine hours. So let me check if it was this class. Here. So the budgeted overhead. So we said that to calculate the OAR, to get the, so we say the budgeted, to get the budgeted overhead of the actual hours, you say the budgeted overhead times OAR. So we say the budgeted overhead per hour is equals to the OAR, sorry. Then the OAR is the budgeted overhead over total budgeted hours. So what I want you to take note of is this formula here. Let me even maybe copy this. Let's copy that one. And bring it here. So the question is, the formula is saying OAR is equals to what? Total budgeted overhead over the OAR is equals to total budgeted overhead over total budgeted hours. So the question then is saying, what is the budgeted hours? So if you did your maths well, or we can even not without using maths, you can just substitute from here. So let's go to the question and see again, what is it that they are looking for? What is it that the question is asking? So the question is asking you, what were the budgeted machine hours? Not the actual. We want the budgeted machine hours. So for the budgeted machine hours, they've given you the overhead absorption rate, and they've given you the budgeted overheads. So going to my formula, they've given you the budgeted overhead, and we need it here. They've given you the OAR, and we have it here. So we can easily work out this one, because the overhead absorption rate is given. It was given as what? Is it 32? I think the overhead absorption rate is 32. Then the budgeted overhead is 2. What is the budgeted overhead, by the way? Our budgeted overhead, please just pick those amounts. It's 216. We are not dealing with the actuals, we are dealing with the budget. So the budget is 216,000 over what we are looking for are the hours, the budgeted hours. So the budgeted hours, I can call them X. So from my maths class, I remember if you are looking for where X is a fraction, the first step is cross multiply. That becomes 32X is equals to 216,000. Then to get your X, you now divide by 32. So that's 216,000 over 32. So what is your X in this case, which is the X is representing the total budgeted hours. So we can say the total budgeted hours work with me. So how much are the total budgeted hours? 216 divided by 32.
6,750.
6,750. So what was I doing here, guys? It's just a matter of reversing the formula. It's like I showed you how you get the OAR, but in this case, they gave you the OAR. Why would they give you the OAR? So just think of it. The moment you see something, they've given you what is usually the solution. Then just come up with the formula. If they give you the OAR, have the formula for OAR down and think of it. Can it not be the one that we can use to pick the answer? So in this case, they've given us our OAR. In most cases, it's us that calculate the OAR. So in this case, they've given us. So slowly put in the formula, then substitute what you have been given. Then now let's move on. Basic company uses regression analysis to forecast monthly costs. The accountant has produced the following equation. So Bensley Company uses regression analysis to forecast the monthly cost. The accountant has produced the following equation. Okay? Where Q is the number of units produced each month, and TC is the total cost in a month. Which of the following statements is correct? Which of the following statements is correct? So that's the total cost function. Total cost is equals to, we have Q, the number of units produced, and the question then says, which of the following statement is correct? the total cost function, what does it say?
Y equals to A plus BX.
Y is equals to A plus BX. That's a good one. So from that, you should be able to tell me the answer. What's BX? What's BX? From Y is equals to A
BX is
BX. What's the BX? The B is representing what? And the X is representing what?
variable.
Yeah, so the BX, the B is the variable cost and the X is the number of units. So this is the same equation. They've just removed the Y and the BX that you are used to, and they have used the Q. But the equation is the same. So what you multiply with the units is the variable cost. What you multiply with the units is the variable cost. So Bensley uses regression to forecast. The accountant has produced the following equation, where Q is the number of units produced each month, and TC is the total cost. So the 4Q, this 4 is representing the variable cost. Q, they've said, is the number of units. So the number of units are multiplied by the variable cost per unit. So the total cost function says that. The total cost function. The total cost is equals to the fixed cost plus the variable cost. That's the total cost. Where total cost, we can say total cost is equals to fixed cost, we can use A, plus the variable cost, we can say the variable cost per unit B times the number of units X. So that's our total cost. In this case, they have not used B, they've given us figures. They've said total cost is equals to the 600 plus the 4. Instead of using X for the units, they've used Q. And they've actually told you that the units are represented by Q. So in this case, the 4 is the variable cost per unit. Then the 600 is the fixed, but let's check from the answers. The variable cost is 600, that's wrong. The annual fixed costs are 28.8. Oh, this is for the month. Q is the number of units produced each month. Uses the regression analysis monthly cost. Oh, those are for the month. Okay. So the fixed cost, we have said it's 600. What is 600 times 12? If 600 is for 1 month, we want to see if B is correct. Is
7.2.
So B is wrong, making C correct, because C is saying the annual fixed cost is 7.2. What about D? Variable cost is 4, that's correct. The fixed cost is 7.2. Where is D wrong? C is 7.2, D is 7.2. What is the difference?
Because 7.2 is saying per month. For
Yes, D is saying it's per month. Per month, it's given as 600, but the annual amount is the 7.2. So the 600 given, the question is saying monthly cost. So this one is 600 per month. The variable cost per unit does not change, even if it's per unit, per month, for a year, for what. But the total, the fixed costs are in total. If they are saying this is per month, it means for the 12 months, we need to multiply by 12. So let's move on. Burgers operates a continuous process into which 3,000 units of material was input in a period. Losses are expected at a rate of 10% of input. Output for the period was 2.9. We have also looked at a question similar to this. What was the cost per unit of output? Then they are saying 300 units abnormal loss, 290 abnormal gain, 400 units abnormal loss, 200 units abnormal gain. So I think the answer is, in other words, the question is not clear, but in other words, they are simply saying, is there an abnormal loss or is there an abnormal gain, and of how much? So can you calculate first? Because if the input was 3,000 and the normal loss expected was 10% and the output was 2.9. So with that, calculate, is there a normal loss, abnormal loss, or abnormal gain? Since the question doesn't have normal loss, it means it's either there is an abnormal gain or abnormal loss. Can you quickly calculate how much is the abnormal gain or abnormal loss? How much is the abnormal gain or abnormal loss?
D.
I got a D. Others are supporting that answer.
D as well.
Okay, so let's verify the D. So 10% is the expected normal loss. I think this one, even without going to our Excel, 10% of 3,000, that's 300 units. We are expecting that the loss is going to be 300 units. But to our surprise, the output is 2.9, meaning the loss was 100 units. So it means we were expecting a loss of 300, but the loss was just 100 units. So we gained. We gained by how much? By 200. Because if you're expecting to lose 300, but you lose only 100, it means you've actually gained. You have set aside that you're going to lose 300, but you lose just 100. You've gained 200. So there's an abnormal gain of 200. For the sake of time, I'm not going to go to Excel to do this one. Let's move. It's again similar to the question that we did last time. Anyone with a question? Okay, when opening inventory was 10,000 liters and closing inventory was 12,000 liters, a company had a profit of 72,000 using absorption cost. The fixed overhead absorption rate was 5 per liter. Good part about this, the more questions you do, the more they repeat the sentence. I remember again talking about this one in one of the revision sessions. So they have given you the profit under absorption costing. And they are asking you, what is the profit under marginal costing? So the basics is to, first of all, understand whether the inventory increased or decreased. If the inventory is increasing, absorption costing reports a higher profit. If it's increasing, absorption costing reports a higher profit. If it's decreasing, it reports a lower profit. So for absorption costing in this case, let's check. The opening inventory was 10,000 liters and the closing inventory was 12. The company had a profit of that. So what's happening? The closing inventory is higher than the opening. The closing inventory is higher than the opening. So if the closing inventory is higher than the opening, it means absorption costing has reported a higher profit. So to show that there is progress, please just quickly do this one because it mimics the one that we did last time. Can you quickly attempt this one? Then maybe we might just do it and revise it together. But since it's a question similar to the one that we did, can we quickly do this one? Yes, can come again. Bowen, you said how much?
62,000.
62,000. Okay, Bowen is saying 62,000. I'm waiting for your confirmation, team. Okay, because of time, let's quickly do that together. So it was 72,000 and 72,000. So absorption costing profit. So we have absorption costing. Profit. Thank. So absorption costing profit. So for absorption costing profit, how much was it? 72,000. Since the inventory is rising, what does this mean? Since the inventory is rising, it means that absorption costing reports a higher profit. So to get to marginal costing, with then less inventory change times OAR. So we are lessing the inventory change times OAR. So the inventory was 10,000. It is changed by 2,000, and the OAR is given as what? How much is the OAR?
5.
5. So I guess Bowen was correct, because if we then say 72 minus 10,000, this should give us 72 minus 10,000 should give us 62. So I guess your answer was correct. Let's move on. Okay, let's proceed. Mountain Venture, Bowen, kindly turn off your mic. Mountain Venture has net assets. Mountain Venture has net assets of 540,000 and made profits of 280,000 for the year. The cost of capital is 8% per annum. What is the return on investment and a residue income for Mountain Ventures? So a return on investment is just equivalent to a return on capital employed. So you're looking at the profit we are going to get from what we invested. So we are going to say the controllable profit over the capital employed. So if it is the return on investment, that's the controllable profit over the capital employed. Return on investment. So for return on investment, we are saying there's the controllable profit over capital employed times 100. Controllable profit over capital employed times 100. That's our return on investment. Then besides the return on investment, we have also residue income. So the residue income, we say that's the controllable profit. Controllable profit minus the imputed rate of interest times the cost of capital, times the capital employed, sorry. Times the capital employed. So the first one, the return on investment, we are now going to, if we don't have, if they have not said controllable profit, we're just using the operating profit that we have. So let's check which profit are we given. We are just given profit of 280. And the net assets are equivalent to the capital employed. So the net assets, that's 280,000 over 540. 280,000. So this one is a percentage. Multiply this by 100. It's a percentage. Multiply that by 100. It's a percent. So there's 280,000 over 540,000. Then we express that as a percentage. That's 52%. Then residue income. Our residue income, we say, the controllable profit is still to 80,000 in this case, minus the imputed rate of interest. Thus, if you're given the cost of capital, we can use the cost of capital. How much is the cost of capital? How much was the cost of capital? So the cost of capital, we are given 8%. So we say 8% of the capital employed. In other words, what are we saying? We are saying we want to confirm whether this project is worth investing in. So we are assuming the money we are going to use is borrowed. Let's assume the money that we have used to buy this, to invest in this project, is borrowed. And we have borrowed the money at an interest of 8%. So we are checking if we invest in this project, is the profit enough to cover the interest? So it's saying we invested 540, but let's assume it was money that we had borrowed and we are supposed to pay interest of 8%. The imputed rate of interest is just an assumed rate of interest. So we want to check whether this project would be giving us profit that's enough to cover our interest. So if it gives us a positive return on residue income, then it's worth investing in. So can you quickly simplify that for me? First, you say 8% of 540, then you subtract that from 280. What do you get? $236,800. $236,800. Okay, let's move on. Do we have an answer like that? D. Number 11. If a company compares its procedures with another company, that's benchmarking. I think we did talk about benchmarking last time. So we're comparing the procedures. The company compares its procedures with another company that it does not compete with. So they've actually ruled out B. We are comparing with another company that we do not compete with. So by another company, they've also ruled out D, because D is not another company. So we are comparing with another company, which is not our competitor. That one would be closely related to the functional benchmark. You can compare with the department of another company, not necessarily your competitor. Strategic is comparing the targets, but in this case, I think functional benchmarking would do. So we're comparing the function of another company. It can sometimes be a company that's not your competitor. A retailer has a mean of 75. Sorry, a retailer has mean sales of 75 per day and a standard deviation of 51. So the standard deviation, you're looking at the measure of spread. How far is the data from the mean? What is the coefficient of variation? So the coefficient of variation is just a matter of you knowing the formula here. The coefficient of variation, we say the standard deviation over the mean times 100. So this one, they aren't just the standard deviation over the mean times 100. So quickly do that. The standard deviation is there. The mean is there. So maybe what I can just put down is the formula. Coefficient of variation nozongotaura nawo then kana paita any issue ndotaura nawo. That's fine. Coefficient of variation. Coefficient of variation, the formula is the standard deviation over mean times 100. So standard deviation over mean times 100. So the standard deviation over the mean times 100. These are passes, and so that we can move to the other stage. I don't see anything difficult. Please, then for those that are joining, that want to join applied skills, we have classes that are starting in July for the December exam. So please make sure you prepare in time for those classes. So a company has budgeted fixed production overhead for 7.5 with the budgeted output of 1,000 units. The company absorbs overheads using labor hours and had a budgeted to work 10,000 hours. Actual output is 790 units and 8,848 hours were worked, and the actual overhead was that. What were the fixed overhead capacity and efficiency variances? So what's important first is to know the formulas. The shortcut to it would be to use sub. I don't know. There are different ways to remember. But if you're calculating the fixed overhead capacity and efficiency variance, we can use sub. Okay, what's sub? So that's standard hours of actual output. So for the units that were actually produced, how many hours were you budgeted? The standard hours. The standard is the budget. So for the units you produced, how much in terms of hours? How many hours did you plan for the units produced? Then we have the actual hours. Used for the units we produced. Then we have the hours we had budgeted, the budgeted hours. We have the budgeted hours. All these, we are going to multiply them by the OAR. We are going to multiply all this by OAR. We're going to multiply all this by OAR. We're going to multiply all this by OAR. Then if you say the standard hours, minus the actual, if you say the answer, you get here minus the answer for here, you get the fixed overhead efficiency variance. Then if you say actual hours minus the budgeted hours, you get the capacity variance. Let's do it together. So I've given you this now. Let's go and get the variables. So we need the standard hours. What do we need? So we need OAR, or overhead absorption rate. We need our standard hours. In this case, I'll just use the abbreviation SR. So we need our standard hours. What is it that we also need? We need our actual hours. What else do you also need? You need our budgeted hours. So these are the variables we need. So our overhead absorption rate, we are going to say, let's go to the question, please. So for overhead absorption rate, you say the budgeted overheads over the budgeted base or budgeted hours. So what's our budgeted overhead? 7.5 over our budgeted hours. So how many hours did we budget? Our output was 1,000 and we had budgeted 10,000 hours. So we are saying OAR is the budgeted overhead over the budgeted hours. So in this particular instance, then the answer is supposed to be 7.5 over 10,000. That's our OAR. Always remember, OAR, it uses, so the OAR uses the budgeted. So the OAR is using the budgeted. I think I did something wrong because 7,000 is smaller than 10,000. How did I get 7.5? So this one is 7,500, not 75,000. The standard hours, we are saying, for the units we produced, take note, how many hours did we plan to use? If you had budgeted that for 1,000 units, you were planning that for 1,000 units, you are going to use 10,000 hours. What was your plan per unit? You are planning that you are going to use 10,000 hours and, you are going to use 10,000 hours and in those 10,000 hours, you produce 1,000 units. What was the budgeted plan per unit? Let's work together. You are planning to use 1,000 hours to produce 10,000 hours to produce 1,000 units. What is your plan per unit? Oh, come on, guys, don't make this look difficult. So you are planning to produce in 10,000 hours and produce 1,000 units. How much is your plan per hour? Even if you use proportion, it can help.
10.
It's 10. So it means your plan is 10 hours per unit. So the plan is 10 hours per unit. So the standard hours, we are saying, using that plan, your plan is each unit is going to take 10 hours. But we did not produce 1,000 units. Your plan was each unit should use 10 hours. But you did not manage to produce 1,000 units. You ended up producing how many units? You ended up producing, the actual output is 790. So Wagunoti, if the 10 hours per unit was for, if the 10 was per unit, What about for those 790? What would have been my budget? You are now flexing the budget to say, I had planned to use 10 hours per unit, but I ended up producing 790 units. So what would have been my plan for those units? Then actual hours is given. These are the hours you used. The actual hours, these are given. So our actual hours are given. Actual output is 790 and 8,848 hours. So the actual hours is 8848. The budgeted hours are the same. The budgeted hours are these ones, the 10,000. So now that we have our variables, let's go and substitute them now. So we have said that the standard hours times OAR, so standard hours is 7,900 times OAR. Or let's do it here in front. So you're saying the standard hours, 7,900 times OAR, which is 0.75. What do we get? 7.9 times 0.75. So if you do that, you get your standard hours at overhead absorption rate. Then you come here, the actual hours, it was 8848 times OAR is still the same, it's not changing. So let's work out that's 8848 times 0.75. Then lastly, we come here. The budgeted is 10,000 times 0.75. So having this, the difference between the first two, if you say the standard hours at actual output minus the actual hours. So if you say this minus this one, it will give you the efficiency variance. So, or you can, good part about Excel, we can just extend and put here. So if we say the answer on top, that's 5,925 minus 6,636. This will give us the efficiency variance. So it will be efficiency variance of how much? What's 5,925 minus 6,636?
Minus 711.
711. Negative, that's adverse. So this one is efficiency. Then we come here, we do the same. This one is now capacity. We again say what is on top, 6636 minus 7.5. We get how much? 864 negative, that's adverse. That's capacity. That's capacity. So there are different ways to this. And I think I'm comfortable with both, but I prefer this one. So you can still use any other way that maybe you were taught or that you understand, as long as it still gets you to the correct answer. So I think the correct answer there with adverse. B sounds close to that, yes. B. Let's move on. Sampling methods. So if a population is very large, but opinions needs to be sourced in the most efficient way. The population is large, but opinions needs to be sourced in the most efficient way from the entirety of a couple of groups. Which method of sampling would be the most appropriate? You want to ask the whole group? The population is large. The population is large, but we want and the population is very large, but the opinions need to be sourced in most efficient way from the entirety of a couple of groups. Which method of sampling would be appropriate? You're saying it's what?
D.
Getting an A, a D. Others, what's your take? So the answer is here. From. So from, I think the English there is a bit tricky. So from the way I take it is, we want to ask the whole group. The population is large, but we want to ask the whole group. So the methods that are most close to this is cluster and multi-state. So for quota, we pick we pick a representative from each quota. For random sampling, every member has equal chances of being picked. But here, opinions needs to be sourced in the most efficient way from the entirety of a couple of groups. This one is a tricky one. Let's flag this one. Let's flag this one. But I think between these two, this one is a kind of tricky. Quota and quota, you're breaking, you first of all divide the population into groups with similar needs and wants. Then we pick a representative from every group. Under random sampling, yes, we are picking, if it's random sampling, every member has the likelihood of being chosen. Groups, yeah, meaning that there has to be groups, because random sampling, we don't group the population. So there have been groups. So where we group the population is these three. But now the distinguishing, there's something I'm failing to pick on. Because quarter sampling and cluster sampling, there is okay. Let's just come here and do this. It's okay. This one can delay us. I'll come back to it because I'm not getting the. Oh, let's try this one. So for quarter sampling, the researcher divides the population into groups, then selects participants non-randomly from each group until a quota is filled. What about clusters? The population is divided into clusters. Instead of sampling individuals directly, the whole cluster is randomly selected, and then all subsets of individuals are then surveyed. So what about multi-stage? The other one is multi-stage.
They are a bit similar.
Yeah, I think for quarter sampling, this one I wrote it out, but for multi-staged and cluster sampling there, regarding the question, I want to. Okay, let's move on. For the sake of time, I'll just check this one because for me, there's two, the B and C. They have similar characteristics. So I'm failing to pick which one is the most appropriate there. So let's move on. Because for cluster sampling, we do the same thing that we do in quarter sampling. We group the population into different quarters. But the difference for quarter, we pick members from each quarter to represent the sample. Then if it's cluster sampling, we randomly pick a quarter. We are not going to be picking members from each quarter, but we ask the whole quarter. So we are asking the whole cluster. The interview is being made on the whole cluster. And for multi-stage, this is more like we want to conduct a sample in Zimbabwe. So we first of all break down Zimbabwe into different provinces. We randomly select a province. We break down the provinces into districts. We randomly select the district. Then maybe we break down those districts further to villages. Then we find one village where we are then going to ask everyone in that village. So I think this one, let's flag it. We can come back to it. I'll check it. Then in the next session, I'll come back to it. Which of the following is a building firm? Which of the following is a building firm? Which of the following is a building firm? Who constructs, am I reading correctly? Which of the following is a building firm? Who constructs extensions to private houses? Most likely to use. Which of the following is a building firm that is constructing extensions to private houses? Most likely to use. So if a firm is constructing houses, extensions to private houses, which one is it likely to use? The firm is into construction and they are constructing extensions to houses. Which costing method are they likely to use here? Yes, C is likely to be most appropriate. Service costing, we can't talk about a service, we are building something tangible. Batch costing, this one, houses, is likely to be, someone would have their different. Batch costing would be if we are dealing with things that we are producing in cartons, of which the extension A might have different extensions to B. Then process costing is for where maybe if you're processing liquids or things that have to go from one process to another. So job costing is the most ideal, because in job costing, you're dealing with a specific job at a time. Then let's move on. The value for money concept used in assessing performance in a not-for-profit organization revolves around 3 E's. So there are 3 E's for value for money. We have economy, efficiency, and effectiveness. Oh, they were actually asking which are the 3 E's. So it's economy, efficiency, and effectiveness. So being efficient is being, if we are efficient, it means we are able to get the most output from the minimum input. So being efficient, we are able to get what we want using very little input. Then effectiveness, it's being fit for purpose. So for government-owned entities, they emphasize on value for money. They want to make sure their services are efficient, they're effective. If they're effective, it's being fit for purpose. That's how they can measure their performance. They don't measure their performance based on profit, but they measure their performance based on effectiveness. If they have hospitals, are they managing to provide treatment? So that is effectiveness. And economy is being able to save costs. We should do it at the minimum cost. So those are the 3 A's for value for money. Ecology, that one is just about environment, concern for the environment. It's not part of the value for money. A company sells a product with the following standard, with the following unit standard cost card. What is the sales volume variance? So what is the sales volume variance? So the sales volume variance is in 2. Whenever they ask you for the sales volume variance, you need to consider, is it sales volume profit variance or is it sales volume contribution variance? So I think I remember mentioning something of that nature in the last session. So the sales volume variance here, we can have, this one is the sales volume contribution variance. So we can also have the sales volume profit variance. So the difference is, if it's the sales volume contribution, we multiply by contribution. If it's the sales volume profit, we multiply by profit. So the question, let's go back to the question and see which sales volume was that. So the question is saying that This card is based on budgeted sales of 1.7 units. The actual selling price was 48. The unit variable costs were 22. The unit fixed costs were 4. Actual sales were 1.8 and 1,950 units were made. The company uses marginal costing. So that's the hint that they've given you. The company uses marginal costing. So if we use marginal costing, remember marginal costing uses contribution. Absorption costing uses profit. So if they are using marginal costing, it means your sales volume variance, it's sales volume contribution variance. So our sales volume variance, sales volume variance. So our sales volume variance is the sales volume contribution variance. So we start with the actual, that's the actual volume. Minus the standard volume. Actual volume minus the standard volume times the contribution. The actual volume minus the standard volume times the contribution. So let's go and check how many units did we actually sell against what we were targeting times the contribution. How many units did we actually sell? So the units sold are here. Actual sales, we're dealing with sales. Actual sales were 1.8 and the budgeted sales were 1.7. Then let's actually check the contribution. So the contribution we use is the standard, not the actual, is the standard. Remember, contribution is the selling price minus variable cost. So the contribution is 50 minus 20, which is 30. So our actual units, we have 1.8. Our standard, we're planning to sell 1.7 times the price is 30, the contribution. So finally, what's our variance? It's 3,000 favorable. 3,000 favorable. Okay, so I think for today we can end here. Then we can resume from there on Wednesday. So Wednesday will be our final session.